on a YOY basis.
Sudarshan Chemicals up nearly 10% on the back of positive commentary by the management in its investor presentation. Company says export market seeing improvement in Europe and North America.
Parag Milk Foods falls over 11% following a muted performance. Profit was impacted by tax expense, while sequential performance is weak owing to seasonality factor. Okay, all right, those are the top headlines. For the Nifty, we are up 55 points. We have recovered a lot from the lows, but just in the last couple of minutes, we've seen a fall from those levels as well. Look at that. So it's around a 35-point downtick from the highs of the day. The mid-cap index is the one which touched a record high today, 52,016 on that right now, 145 points higher. And what has led to that decline in Nifty is, again, what's happening with the Bank Nifty. So it's 42 points lower. The underperformance there continues, and we have seen a lot of broader market movers as well in the market today, and earnings, they keep coming in. We do have a lot of news flow to track as well, but for now it's the mid caps which continue to charge ahead.
Mid-caps continue to chart fresh highs, and that's the positive, as we start the show today. Lots lined up. Now, the metal pack, the commodities pack today is doing quite well. And I'm sure, Hormaz in our special segment, mid-cap movers, will have the list of mid-caps, and I'm sure a few commodities in there.
It's always a good headache to have, right? What stocks to pick when you're doing a movers link like this, because there's so many stocks moving around. So we'll start off with some of the gainers in the mid-cap space before we head into the specific sectors that are doing well. And Aditya Birla Fashion is among those stocks that are among the top gainers on the mid-cap index this afternoon, 7.5% higher. Mind you, the stock is in the F&O ban. Bank of Maharashtra, HPCL, Honasa Consumer, the management just spoke to us earlier in the day. That stock is also seeing a good day in today's session. But even when a day when the broader markets are outperforming, the PSUs are doing even better. Par for the course, I guess. RVNL is at a record high, 14% higher. IRCON ahead of earnings rights after that order win, and IRFC also nearing its record high of 192, doing very well for themselves. So non-rail PSUs are also doing well in today's trading session. Stocks like NHPC, HUDCO is up another 11%. That's a record high as well. SJVN is up 9%. BEL is a record high, 6.5% off the highs of the day, but still trading with substantial gains. And Bharat Dynamics, all the defense PSUs doing very well in today's trading session. Some stocks that are doing well on the back of heavy volumes, and they'll come up on your screen. Poly Medicure, the management spoke to us on Saturday, 7.5% higher there. Balkrishna Industries, brokerages are a little cautious, but the street doesn't seem very cautious there. 10% higher. Chinese Tech and Kalpataru Projects, after that order win from Aramco, is up 4.5% as well. And lastly, some stocks that are bucking the trend. You highlighted Parag Milk Foods in the headline there. Delivery is another one, such a casualty, 10.5% lower today. Aptus Value after the block deal. City Union Bank and Astral for the second day in a row now is down 5% in today's session. Back to you.
Okay, an interesting list. So a lot of earnings that are coming in. We are towards the fag end of the earnings season as well. Thank you so much, Hormaz, for joining us as always and taking us through some of these mid-cap movers. But let's now focus on the financial sector. In a recent note, Emkay Global recommends investors to go bottom up in the financial sector and cut exposure in index heavyweights. They have cut exposure in index heavyweights. They have reduced the weightage of financials in model portfolio, and it has halved to 15% from 30% earlier. To discuss this and more, we have Seshadri Sen, the head of research and strategist at Emkay Global, joining us now. Mr. Sen, good afternoon. Thank you so much for joining us. Well, can you explain the reason of your stance on private banks? You've cut exposure in the index heavyweights and you see continued derating as well for large cap private banks. What is worrying you here?
Thanks for hosting me on your show, Sonal. We are basically going top down for this sector. Our basic thesis here is that, the sector has become, the word we've used is X-growth. We've been used to private sector banks growing at in the 20s as far as loans are concerned. And that has knocked on to strong earnings growth, book value per share growth as they continue to raise capital at premiums. Post-COVID, post a couple of years into COVID, that growth seems to be tapering out. On the one hand, wholesale growth is slower than what it used to be, especially because both lenders and borrowers are in extreme risk-off mode. Retail growth, which has driven overall system growth, will also slow down, we suspect, because of the RBI's new guidelines on lending to unsecured retail. And the private banks are no more gaining share from the PSUs at the frantic pace that they used to in, say, the noughties and the first half of the teens. So all in all, we're seeing lower growth. Avenues for supernormal profitability are also narrowing. Most high-risk sectors, either the lenders themselves or the regulators asking them to slow down lending to those segments. So possibility of gaining supernormal ROAs is also contracting. So all in all, we are in an era where both growth and ROEs will be far more tempered than they used to be. In that context, we don't think valuations have adjusted downwards enough. We think there is more derating to go. And we are broadly constructive on the markets. We think that the manufacturing side of the markets will going to perform. So banks on an absolute basis may deliver some performance, but on a relative basis will continue to underperform the broader markets.
Right. Good afternoon, Mr. Sen. Thank you so much for joining us here. In your note, you've also mentioned that while you're not quite constructive as far as private banks are concerned, something that you've mentioned and you've also given us the reasons for, you're also not very positive when it comes to the PSU banking space. So you're underweight as far as the entire banking pack is concerned. Do you feel that valuation gap between PSUs and private banking, you think that particular trade has largely played out?
Yes, I think the macro trade in terms of the re-rating of the PSU banks has largely played out. That doesn't mean that there won't be select opportunities in the PSU banking space. There will be, and there will be small to mid cap stocks which will deliver very strong performance, I think, in the PSU banking space. But that's more bottom up. But from a top down perspective, the sort of value trade, when PSU banks were trading below book while asset quality worries had been sorted out. As I just said, PSU banks are also growing faster. They're not losing market share to the private banks at the same pace that they used to. All that is now largely in the price, and you've got to start picking up individual stocks rather than play the broad theme as a whole.
So in your bottom-up approach, are there any PSU names that you like? What are the other names that you have selected here? I see that you have exited heavyweights like HDFC Bank and ICICI. But what is it that you have added?
So our bottom up, our model portfolio is largely focused on large cap and largish mid cap stocks. So we pick stocks with definite definite triggers ahead of them, where there's a valuation gap with the peers, or there are specific franchises there which are or with specific asset categories which are on a high cyclical upturn, or in some other cases there's a new management which is turning the stock around. So that's the basis for us picking up the stocks from a bottom-up perspective.
Mr. Sen, I also want your view, because there has been quite a lot of regulatory action that has come about as far as banks are concerned, especially if you look at names like Kotak Mahindra Bank. Also, there have been some curbs that have been introduced in terms of lending to the infra space. How do you see that impacting loan growth as well as margins for FY25, and who do you think will be more impacted?
Well, I think the regulatory action, which is, I think, very positive for the macro over the longer term. Let me clarify that, because macro financial stability is the bedrock of the post-COVID growth run that India is having, and therefore one can hardly fault the regulator for being proactive in trying to curb risk in the system. But there will be three areas in which it will hurt the banks. First is, of course, growth itself, because some specific areas the RBI is advising banks not to go overboard in lending. That hurts growth opportunities. The second is margins as well, because some of these growth opportunities, say unsecured loans, for example, unsecured personal loans, are higher margin than the rest of the book. You stop doing that, it will also affect margin. May not happen immediately, but will over 2 to 3 year period, it will start to impact margins, because secured lending is now very low margin and very low ROE, given the competition that is there in that space. And thirdly, the other area where the RBI is pushing the banks is to have fewer tech failures and up their tech game. That would mean that some tech investment will have to be stepped up by the banks. And I'm not sure that this is completely in the analyst forecasts and in the estimates. So you could see some cost income pressures as well start to come through as the banks ramp up their tech investments.
And that is something that you've mentioned in greater detail in the report as well. You have spoken about some pressure coming in on CASA ratios across the sector, and that is because of higher awareness and ease of digital transactions. Do you think that is a structural change and that would continue to put pressure on CASA ratios, or there could be some reversal here?
On that, actually, most of it is cyclical because, in their inflation combating stance, the RBI has kept liquidity fairly tight. And since for most part of CY24, you've seen liquidity, bank liquidity being short and short at, in a +1 standard deviation zone. In that context, banks are stressed out for liquidity, and that has an impact on CASA ratios as well. So on that is one which is cyclical. Once we get to the easing part of the cycle, though we don't have visibility on when that starts, our view is that probably this year the RBI will remain tight on liquidity. But in that area, that's cyclical. So some of that, I think, over the next 12 to 18-month period will start to ease, and some of those numbers will start to look good. But just a word of warning, at the top end of the cycle, when rates start falling, given the construct of balance sheets, mortgages will drop first. And in the short term, you could see some margin pressure. It will be short term, it will be transient, but that may be a bit of a short-term shock to the system, not happening immediately, probably sometime in calendar 25.
Well, thank you so much for your time, Mr. Sen. It was a pleasure having you. We'll have you once again, once maybe you turn a little bit more constructive on the banking pack. But, that's the time we have for this particular conversation. We'll slip into a short break. When we return, we will be joined by the management of Atul Auto to discuss the quarter gone by. Stay tuned.